6 consecutive years. Not one difficult year followed by a recovery. Not 2 years of market stress that corrected itself. 6 straight years where the entire world consumed more silver than every mine on the planet could produce. And this year, the gap is not closing. It is widening. The institutions know. The refiners know. Even the vaults are beginning to signal something that the mainstream market is desperately trying not to say out loud. What happens when the paper runs out of metal to back its promises? Stay right there, because what comes next will completely change the way you see this market. Welcome to the hidden currency, the one place where the numbers speak first, and the noise is left at the door. Now, if you have been around long enough in life to know that the best opportunities never announce themselves loudly, that they arrive quietly, dressed in data, hidden inside reports that most people never read, then this channel was built for you. Do us a small favor, the kind your grandchildren would be proud of. Hit that subscribe button, not for us, but so that you never miss the moment the market finally tells the truth. And before we go any further, drop a comment below and tell us where in the world you are watching from today, because this story belongs to all of us. On April 14th, 2026, a report landed quietly on the desks of analysts, institutional traders, and commodity researchers around the world. It did not make front-page headlines. It was not discussed on mainstream financial television. Most retail investors never heard about it. But inside that document, published by the Silver Institute in their annual World Silver Survey, sat a single number that carried more economic weight than most people were prepared to handle. That number was 46.3 million troy ounces. That is the size of the silver deficit projected for the year 2026. And what made it truly alarming was not the number itself. What made it alarming was the word behind it, 6. 6 consecutive years. Not one difficult year followed by a recovery. Not 2 years of imbalance that the market self-corrected. 6 straight years where the entire world, every solar panel manufacturer, every electronics company, every industrial fabricator, every mint, and every investor combined, consumed more silver than every mine on the planet was able to produce. That is not a cycle. That is not a temporary demand shock. That is a structural deficit, and understanding the difference between those two things is the most important intellectual task any serious business person or entrepreneur can perform when looking at this market right now. A cyclical deficit is manageable. It happens when demand spikes suddenly due to a short-term event, or when a supply disruption hits a key mining region. The market feels the pressure, prices rise, investment flows back into production, new supply comes online, and the system rebalances. That is how healthy commodity markets are supposed to function. But a structural deficit operates by a completely different set of rules. A structural deficit means that the underlying architecture of supply and demand has shifted in a way that normal market corrections cannot quickly fix. It means the gap between what the world needs and what the earth can provide is not closing on its own. And when that kind of deficit runs for 6 consecutive years, something very serious begins to happen beneath the surface. Above-ground silver stockpiles start to disappear. Every year that production falls short of consumption, the world must reach into its existing reserves to make up the difference. These are the silver stockpiles that have been accumulated over decades, sitting in exchange vaults, in industrial warehouses, in government holdings, and in private storage. For 6 years, that reserve has been drawn down. The cumulative effect of 6 years of deficit consumption is staggering. Analysts who have studied the numbers closely point out that the total volume of silver pulled from above-ground stockpiles during this 6-year period is roughly equivalent to an entire year of global mine production. That silver is gone. It has been consumed, fabricated, used, and in many cases permanently embedded inside products that will never return it to the market. And yet, if a person turns on a mainstream financial news channel today and asks about silver, they will almost certainly hear the same tired framing. They will hear that silver is a speculative commodity. They will hear that it is simply a cheaper alternative to gold, something people buy when they feel anxious about the economy. They will hear analysts describe it as a volatile, emotionally driven trade with no strong fundamental backing. That framing is not just incomplete, it is structurally wrong. And it is wrong in a way that has real financial consequences for anyone who accepts it without question. The reason this framing persists is not complicated. The mainstream financial media covers markets primarily through the lens of price. And for years, the price of silver has not fully reflected the reality of what the supply and demand data has been screaming. When price and fundamentals disconnect for long periods of time, most commentators default to trusting the price and dismissing the fundamentals. But what they fail to account for is the mechanism that is keeping that price artificially disconnected from reality. That mechanism is the paper silver market, and it is the single most important thing any serious person needs to understand before they can make sense of what is actually happening right now. This is not a story about silver being a safe haven. This is not a story about inflation hedging or portfolio diversification. This is a story about a physical commodity that the world genuinely cannot function without, running 6 consecutive years of structural shortfalls, while the financial system responsible for pricing it operates on a set of assumptions that are becoming more dangerous with every passing quarter. The foundation is cracking. And the only question that matters now is whether the people positioned to act on that knowledge will do so before the rest of the market finally wakes up. Imagine walking into a bank and asking to withdraw $1,000. The teller smiles, hands you a receipt, and tells you that the receipt is just as good as the cash. You can trade it, spend it, and use it anywhere. But when you ask to see the actual physical dollars, the teller lowers their voice and admits that the bank only has 50 real dollars sitting in the vault. The other 950 exist only on paper. Most people would walk out of that bank immediately. They would call it fraud. They would demand answers. And yet, this is almost precisely how the global silver market has been operating for decades. And almost nobody is talking about it. The silver market is not one market. It is 2 completely separate realities that share the same price tag. The first reality is the paper market. This is the world of futures contracts, exchange-traded products, and synthetic financial instruments that trade on exchanges like COMEX in New York and the Shanghai Futures Exchange in China. Every single trading day, an enormous volume of silver changes hands on these exchanges. The numbers involved are difficult to absorb. The total notional volume of silver traded daily on these paper markets is approximately 10 times larger than the entire annual global mine production of physical silver. 10 times. That means in a single day, the paper market trades more silver than the world's mines produce in an entire year. And this happens every day, 5 days a week, 52 weeks a year. The second reality is the physical market. This is where actual silver moves. It travels from mines to refineries, from refineries to fabricators, from fabricators to industrial manufacturers, and from manufacturers to the final products that the world depends on. In this market, there's no such thing as infinite liquidity. There is no button anyone can press to create more silver. Every ounce that exists had to be pulled from the ground, processed, transported, and stored at real cost. These 2 realities, the paper world and the physical world, have operated side by side for most of modern financial history. And for a long time, a mechanism existed that kept them connected and roughly honest. That mechanism was called arbitrage. The logic was simple and elegant. If paper silver became significantly cheaper than physical silver, a trader could step in, purchase futures contracts on the paper market, demand actual delivery of real metal, and then sell that metal in the physical market at a profit. This delivery mechanism was the invisible thread connecting the fictional world of paper to the real world of physical metal. As long as traders could actually demand and receive delivery, the 2 markets could not drift too far apart. The paper price was disciplined by the constant possibility that someone could call its bluff and demand the real thing. But here's where the story takes a turn that most financial commentators are unwilling to follow to its logical conclusion. That arbitrage mechanism only functions if there is sufficient physical silver sitting in registered exchange vaults ready to honor delivery demands. It is the inventory behind the paper promise that gives the promise any meaning at all. And what has been happening to that registered inventory at COMEX, the exchange that effectively sets the global silver price, is one of the most significant and underreported financial developments of this decade. The registered silver inventory, meaning the metal that is actually available and committed for delivery, has been declining. Not gradually, not smoothly, but in a pattern that tells a very specific story about the growing tension between paper commitments and physical reality. When registered inventory falls while paper trading volume remains enormous, the leverage ratio between paper promises and real metal grows wider. What was already an aggressive ratio becomes something closer to reckless. And when industrial consumers, the solar manufacturers, the electronics producers, the defense contractors begin stepping into that market not to trade paper, but to take actual physical delivery of real metal, the system does not adjust smoothly. It does not send a polite signal asking for more supply. It seizes, it dislocates. Prices do not rise gradually in an orderly staircase. They gap violently as the fiction of infinite paper supply collides with the hard wall of finite physical reality. History has seen this before. In March of 2022, the nickel market on the London Metal Exchange collapsed so violently that the exchange was forced to halt trading entirely and cancel billions of dollars worth of executed trades. That was a market with far less leverage than silver currently carries. The silver market is not approaching that kind of structural stress. By several honest measures, it is already inside it. And the registered vault numbers are the proof that the paper market can no longer afford to have anyone look at too closely. There is a particular kind of economic trap that history reserves for commodities that the world underestimates. It begins quietly. A material that was once considered a financial asset, something traded in markets and stored in vaults, slowly transforms into something far more consequential. It becomes infrastructure. It becomes embedded so deeply inside the technology that modern civilization depends upon that removing it, replacing it, or simply running short of it stops being a financial inconvenience and starts becoming an operational crisis. Silver has crossed that line, and the moment it crossed it, the entire conversation about its price, its deficit, and its future changed permanently. Most people who hear the word silver still picture jewelry. They picture coins stacked in a collector's cabinet or bars sitting in a private vault somewhere. That image is not just outdated, it is dangerously misleading for anyone trying to understand where this market is actually headed. Today, the single largest and fastest growing source of silver demand on the planet is not jewelry, not coins, and not financial investment. It is industrial fabrication. And within industrial fabrication, one sector above all others is rewriting the demand equation in a way that no mining company, no financial exchange, and no government policy can easily reverse. Solar energy is consuming silver at a rate that would have seemed impossible to believe just a decade ago. Every solar photovoltaic panel manufactured anywhere in the world requires silver. Not as a decorative component, not as an optional enhancement, but as a core functional material embedded inside the electrical contacts that make the panel work. Silver is the most electrically conductive metal on Earth. No alternative material currently performs the same function at the same efficiency level at industrial scale. As global solar installation targets have expanded dramatically under climate policy commitments made by governments across Europe, Asia, and North America, the volume of silver being permanently consumed by the solar industry has grown at a pace that consistently surprises even the analysts who track it most closely. In 2025 alone, solar photovoltaic manufacturing consumed an estimated 232 million troy ounces of silver. That single sector, by itself, absorbed more than a quarter of total annual global mine production. But solar is only one piece of the industrial demand story. Electric vehicles are adding another layer of structural consumption that compounds the pressure. Every modern electric vehicle contains silver inside its electrical systems, its battery management components, its charging infrastructure connections, and its increasingly sophisticated onboard sensor arrays. As global EV production scales toward the targets that major automotive manufacturers have publicly committed to, the silver demand embedded in that supply chain scales with it. Unlike investment demand, which can evaporate overnight when sentiment shifts, industrial demand tied to manufacturing commitments, government contracts, and infrastructure build-outs does not disappear because the silver price rises. It absorbs the higher price and continues because the alternative is halting production entirely. This is the concept that economists refer to as price inelasticity. When a material is so deeply embedded in a production process that no affordable substitute exists, the buyer does not stop buying when the price increases. They pay the higher price because stopping production costs them far more than the incremental increase in raw material costs. Silver, across solar, electric vehicles, semiconductors, medical devices, and advanced defense systems, has achieved that level of inelasticity across multiple industries simultaneously. That is an extraordinarily rare and powerful economic condition. It means the floor beneath silver demand is not soft. It is structural, policy-driven, and locked in by capital investments that have already been made and cannot be easily unwound. Now place that demand reality alongside the supply reality. Global silver mine production has been essentially flat for several years. New major silver discoveries are rare. The lead time from discovery to production for a new silver mine is measured not in months, but in years, sometimes in decades. Even if the silver price doubles tomorrow, the mining industry cannot respond with meaningful new supply inside a time frame that would relieve the current deficit. The pipes are already running at close to full capacity. And the ore grades at existing mines, meaning the concentration of silver in the rock being extracted, have been declining for years as the richest deposits become progressively depleted. What this creates is not a temporary supply squeeze that the market will self-correct in the next reporting period. What this creates is a convergence point, a place where an irreversibly rising industrial demand floor meets a structurally constrained and declining physical supply ceiling. Every serious commodities analyst who has studied this convergence honestly has arrived at the same uncomfortable conclusion. The numbers do not balance. They have not balanced for 6 years, and the industrial forces now driving demand are not slowing down. They are accelerating, which means the question is no longer whether a significant market dislocation is coming. The question is how close the market already is to the moment when the last buffer disappears entirely. Markets do not break all at once. That is the detail that most people miss when they study financial history after the fact. They look at a chart, see the moment where a price collapsed or exploded, and assume that the crisis arrived suddenly without warning. But that is never how it actually happens. Before every major market dislocation in recorded financial history, there was a period of accumulating pressure, a period where the signals were present, where the data was available, where the informed observer could see the structural cracks forming in real time. The crisis did not arrive without warning. The warning arrived without an audience. And right now, in the silver market, the warnings are not subtle anymore. To understand what a true market dislocation looks like before it fully arrives, it is worth examining two precedents that carry direct structural relevance to the silver situation unfolding today. The first is palladium between 2019 and 2021. Palladium is a small industrial precious metal used primarily in catalytic converters for internal combustion engines. For years, analysts flagged a growing structural deficit driven by tightening emissions regulations that were forcing automakers to use more palladium per vehicle. The mainstream market largely ignored those warnings. Then, over a period of roughly 18 months, the price of palladium rose from approximately $1,000 per troy ounce to over $2,700. It did not move in an orderly gradual staircase. It moved in violent, disorderly surges, as industrial buyers who had delayed securing supply suddenly competed for a metal that was not available in the quantities they needed. The deficit had been visible for years. The dislocation, when it arrived, shocked almost everyone who had not been paying attention. The second precedent is even more instructive. In March of 2022, the global nickel market experienced something that the financial world had not seen in decades. A massive short position held by a major Chinese nickel producer collided with a sudden supply disruption caused by geopolitical events. The nickel price did not rise. It detonated. Within 48 hours, the price of nickel on the London Metal Exchange more than doubled, moving from approximately $29,000 per ton to over $100,000 per ton at its peak. The London Metal Exchange, one of the oldest and most respected commodity exchanges in the world, was forced to take the extraordinary step of halting trading entirely and canceling billions of dollars worth of already executed trades. The system did not bend under the pressure, it broke. And nickel, it must be noted clearly, did not carry anywhere near the paper-to-physical leverage ratio that the silver market carries today. These precedents matter because they illustrate a principle that experienced commodity traders understand deeply. When a structural deficit runs long enough, when above-ground inventory falls below a critical threshold, and when paper market leverage ratios grow wide enough. The transition from a functioning market to a dislocating market does not happen gradually. It happens at the speed of a margin call. And the leading indicators that precede that transition are already visible in the silver market for anyone disciplined enough to look at them without bias. Silver lease rates, which represent the cost of borrowing physical silver for short-term industrial or financial purposes, have been showing elevated and increasingly volatile readings. When lease rates rise sharply, it signals that physical metal is becoming genuinely difficult to source in the quantities and timeframes that borrowers need. Futures market premiums for near-term delivery contracts relative to longer-dated contracts have been compressing and in certain periods inverting, a condition known as backwardation that in commodity markets almost always signals acute physical tightness rather than speculative sentiment. And perhaps most telling of all, the behavior of institutional participants in the silver market has been shifting quietly but decisively. Large, sophisticated buyers have been moving away from paper silver instruments and toward direct physical acquisition through allocated storage arrangements, private refinery contracts, and off-exchange bilateral transactions. They are not doing this because they believe silver will go up. They are doing this because they no longer fully trust that the paper market will be able to deliver physical metal when they actually need it. For the business leader, the capital allocator, and the entrepreneur watching this situation develop, the strategic implication is not simply about whether to buy silver. The deeper implication is about understanding what a silver dislocation signals about the broader architecture of commodity markets and the supply chains built on top of them. Every industry that depends on silver as an input material, from clean energy manufacturing to advanced electronics to medical technology, is now operating with a hidden structural vulnerability that most corporate risk management frameworks have not yet fully priced in. The businesses that recognize that vulnerability now and build supply security into their strategic planning will not simply survive the dislocation. They will be the ones positioned to define the next era of industrial advantage, while their competitors are still waiting for the mainstream financial media to tell them something is wrong. By the time that announcement comes, the window will already be closed.